We started GrowthLab with a focus on startups. And one of the most typical business models we have in the startup world, well, it's SaaS-based businesses. SaaS-based businesses are actually quite unique, but they're not uncommon, they're not unusual, but there are three things that are very important when you're thinking about accounting and financial planning and business strategy, frankly, for your SaaS-based business. Number one on the accounting side is definitely deferred revenue and revenue recognition. Number two, on the operational side and customer success side, it is customer churn. Customer churn can kill companies. And number three, well, we talk about customer acquisition and that lifetime value of that customer. Deferred revenue. Well, investors love deferred revenue. Why? Because your customer base is in essence funding your operations, funding your business. They tend to pay you up front for 1 to 2 years of service. And then on the accounting side, you've got to defer most of that revenue, and you recognize that revenue month over month. So your accounting team has to understand the importance of deferred revenue and how to calculate it. As for customer churn, that is really not an accounting term. It is more of a finance, maybe more of a sales, customer success term. Customer churn is important because remember, it's a lot easier to keep a customer than it is to go out and find a new customer. So customer churn comes into play when we're building out financial models, building out a team that is capable of ensuring that a customer is highly engaged and that your product is ultimately sticky. Let's talk about customer acquisition costs. Many companies, when they start off, well, their first 10, 20, even 100 customers tend to be, well, friends and family, right? But over time, that begins to dry out, and you have to start identifying who your customer, your addressable market, and you have to start going and acquiring new customers. In the days of Google AdWords, Facebook ads, Instagram, it's too easy to say, well, my customer acquisition cost is $100 per customer because I spend X on ads, and ultimately I expect a conversion rate of Y. But it's too easy to throw good money after bad money. And so we want to be careful with customer acquisition costs. And one way to do that is to stay hyper-focused on your marketing. And as you're thinking about your financial planning and strategy, making sure that you've grounded these KPIs in experience, right? And so you tend to experiment and you take that information and you build it into your financial plan. The last piece is that lifetime value, which is kind of like a murky ratio. There are many ways to skin that cat. I personally like to look at lifetime value from the lens of what gross margin looks like versus what is the duration of that customer engagement. And you can't really tell as a startup. It could be 3 years, it could be 5 years, who knows? But coming up with a thesis behind that and ultimately trying to understand, am I making more money over that 3 or 5 year period than what it cost me to acquire that customer? So there you go. 3 areas that you want to think about. So when you're picking a financial services partner, make sure that they have the expertise that you need for your SaaS business.